I try to be an optimist, but I try not to be stupid. General Colin Powell. Hey there, welcome to the Retirement Answer Man Show. My name is Roger Whitney. I am your host. Now, this show is dedicated to helping you not just survive retirement, but have the confidence to lean in and rock retirement, even in a bear market. Love that quote from General Powell. I'm trying to recall the name of the book that it came from. I read a philosopher's note on the book from Heroic. I'm meaning to buy the book, so I'll let you know what it is when I can remember it. But I love that. I try to be an optimist, but I also try not to be stupid. And we've been talking about optimism recently, and I think being optimistic and pairing that with the good to great concept from Jim Collins of productive paranoia, what am I missing? What should I be paying attention to? Is a good combination, whether times are good or bad, and whether we're optimistic and happy or a little worried about things. So we're going to start answering your questions this month again in November. But I did want to let you know that starting in 2023, we're going to have a retirement plan live case study in January. And in the next few weeks, we'll be sharing how you can raise your hand and to be considered as a subject. This is where we take a listener, sanitize who they are. I work through building a retirement project with them, and then you get to listen in to me and this listener step by step through the process. And we have a big get together and look at the results. So we'll be doing that again in January. Look for something here in the next few weeks about how to raise your hand if you're interested. We haven't figured out the profile yet, but I have some ideas. Also, next year, we're going back to monthly themes. We sort of put that to the side to answer a lot of your questions, which we're going to do this month. But we're going to go back to doing some monthly themes along with answering your questions. I'm excited about that. So have some good ones coming. And then lastly, we're going to start implementing some different segments in. We're going to have functional health on a regular basis, heroic retirement on a regular basis. We're going to frame the questions related to what stage of the process the question's related to, vision, feasible, resilient, or optimized. I'm excited about all these little changes, but for now, let's get to answering your questions. Today's show is sponsored by Cozy Earth. Stay warm and wrap yourself up in Cozy Earth this holiday season. Featured on Oprah's Favorite Things, which is sort of cool. All their products are made from responsibly sourced viscose from bamboo. I don't know what viscose is, but what I do know is that the sheets that we have from Cozy Earth are the most comfortable sheets I've ever slept on. My wife says the same thing. They're just amazing. Even as you wash them, they get softer, at least in our experience. And the cool thing is Cozy Earth has loungewear as well, made from the same material. And they have loungewear for men as well. So this holiday season, whether it's for yourself, for your spouse, or for someone you love, give them something that they're going to just love. Give them some Cozy Earth. Go to CozyEarth.com, and they've given us an exclusive code where you'll get 35% off site-wide if you enter RAM as a discount code. So check out CozyEarth.com. If you would like to ask a question to me, go to rogerwhitney.com/Ask Roger, and you can write in a question. You can leave an audio question, and we'll try to answer it on the show. If you leave an audio question, that's like a fast pass. We're trying to elevate those, so there's a pro tip. Our first question today comes from Keith related to commodities. Keith says, I would love for you good folks to address even lightly the benefits and risks associated with investing in the public commodity ETF world, notably the ones that follow the commodity indices and possibly the more specific commodity indices as a pure inflation hedge. I see the benefits of real estate and equity-related commodity companies rather than shrug off commodity ETFs as too risky, too exotic, too pork belly investment-like. I would love someone to explain it more objectively as to the merits or non-merits of being included in a portfolio. That's a great question, Keith. So let's do that. Now, my disclaimer here is that I came to my own conclusion on this subject a number of years ago, and I haven't refreshed it recently. So just disclaimer there. So let's talk about what your question is. And I want to set the table a little bit. What is a commodity? A commodity is generally a hard good. We think of gold, silver, oil, corn, copper, hard things that generally have some economic benefit that go into products. So that's generally what a commodity is. Unlike most other investments, commodities are a capital gain type of investment, meaning that they do not throw off dividends or interest. The return profile is simply from buying it at one price and selling it at a higher price. That's where the return comes in. As bad as bonds and stocks are this year, they're paying interest, they're paying dividends. Those are compounding over time, and you have that compounding effect. Commodities don't have that. They're a good. Now, the attraction of commodities as an investment is that generally they are not correlated with other assets. So correlation is this concept. If I own asset A and asset B, if asset A goes up, and every time asset A goes up, asset B goes up, that would be a positive correlation. They move in tandem, maybe not perfectly, dollar for dollar, but they move similarly. Whereas if one asset goes up and the other one always goes down, that would be a negative correlation. And one of the attractions of commodities is that they're generally uncorrelated or negatively correlated to stocks and are positively correlated to inflation. If inflation rises, generally commodity price rises. So that's one of the attractions, especially at a time like this when interest rates are rising and inflation is rising or high, is that commodities generally are positively correlated with that. So it's like, hey, it would be nice to own some of those right now. And just like when stocks go down, generally commodities go up, or at least not down with it in a positive correlation aspect. So that's some of the attraction of commodities. So let's go a little bit deeper. How do you invest in commodities? Well, there are a few ways. One is you can go buy the direct commodity. You can go buy some oil and put it in your garage. You could go buy some gold coins, put them in your safe. You could go just buy the commodity and hold it. And that's not generally what someone does because commodities are big and it's cumbersome to buy them and store them, etc. Another way to invest in commodities is, and this is what Keith said, hey, I don't want to talk about that part of it, is to buy companies that participate in or have that manage some of those commodities. A good example might be Exxon. Exxon owns a lot of oil and natural gas. So if I buy Exxon, they have a lot of exposure to oil and natural gas. And as Keith points out, but they also are equities. They're in the stock market. They have a lot of other things going on. They're not a pure play. Just like a real estate investment trust isn't necessarily a pure play on real estate. There's a lot of other things going on there. So to get to quote unquote more purity in these commodities, we're not talking about owning it directly. We're not talking about equity investments in companies that deal with them. How do I just buy or mimic the commodity indice, the oil index or the gold index or the corn index or thousands of commodities? The normal way for someone in the public to do it is to own exchange-traded funds or exchange-traded notes, which are just a derivative of ETFs and a few differences there, that play in these commodity worlds. And that was very popular starting in the mid-2000s. And the reason you want to use those or could use those is because you can't actually buy an index, right? The S&P 500 index, as an example, is roughly 500 companies, all a different asset allocation. Technically, you could go buy each individual stock in the right allocation, but that would just be a bear to manage. So they have mutual funds that replicate the mathematical model of an index to get you that exposure, and it's graded by its tracking error. How well does it match the individual index that it's trying to track? A little bit similar in commodity ETFs or ETNs. is that there are some that will buy the actual commodity and hold it. So that might be a little bit closer, but their costs are going to be the transactional costs of having to buy in the markets and buy and sell in the markets, but also physically holding the commodity. Hard part with commodities is that they're really big, right? Generally. Gold, you think of Fort Knox. If the commodity ETF actually owns the gold, and there are some that are out there, that there's a cost to having all that space and the security and everything else. The more popular commodity-based ETFs or ETNs, they use contracts, future contracts, and swaps, which are financial instruments that represent the ownership of something without actually having to own the thing. So they're a financial contract, so they're not organic, they are manufactured. So there's some different ingredients in there because that's much easier to manage and a lot less friction. Generally, the way that those funds do that is to buy, I think, 1 month forward or future contracts. So they're buying a future that represents the ownership. And so they have to continually buy the future contracts over and over again. And there can be some degradation in how well it tracks the commodity all at once or over time because of the friction related to constantly having to renew these future contracts. Back in the day, this maybe 2008 into the teens, you would see that these would track commodities, but all of a sudden you'd have these big tracking error events based on interest rates and a number of other things. I haven't refreshed my thinking on where all that stuff sits now. But do these have a place in a retirement portfolio? That's essentially what Keith is asking. My short answer is, Keith, maybe. I'm not opposed to them as an asset class within an asset allocation. So I'm not opposed to that. I think this would go into the layer that is your growth allocation, which is going to be the most volatile in the longer term allocation, where it's more stock, real estate heavy. You could add some commodities in there. I'm not opposed to that. And then you'd have to work through which vehicle do you use to represent commodities within that asset allocation. So that'd be one question. Another question, I think you hit on this, is what commodity do I track? Because a lot of these ETFs are commodity specific. My suggestion would be is to not pick a commodity, but find something that represents a basket of commodities. Now you add a little bit more complexity because now they're dealing with future contracts over multiple markets. So there's more complexity, more chance for things to go wrong there. But I think a basket would be better than one specific commodity. Then you come down to, Keith, how much do I put into that long-term growth portfolio? What's the right percentage? That's where it gets a little bit tricky in that you want to put enough so it actually makes a difference in your portfolio, but you don't want to over allocate to that asset class because it's not going to give you dividends. It's not going to give you interest. It's only a capital gain, and commodities can be really, really good and they can be really, really bad. They're very volatile relative to other asset classes. In the asset allocation models that I have seen where commodities are included, it ends up being 5%, maybe 10% in a very growth-oriented portfolio. And so you'll have to ask, is that really enough to make a difference? And that's usually the issue that we're dealing with it, whether it's commodities or alternative investments. Okay, in theory, these have these great diversification attributes relative to more traditional asset classes for the public, because commodities is a traditional asset class in business. But if you don't add enough to actually make a difference, all you're really adding is complexity, right? And so how much do you add? I don't know, because I don't add commodities in the structure of things that I do. And I came to that decision. Maybe I need to refresh that. It's definitely the time. It's sort of sexy right now to refresh your thoughts on commodities. If you do add commodities and you figure out the percentages, Keith, what I would suggest you do, though, this is a long-term decision. You're going to rebalance even when commodities are horrible, and they can move very quickly, right? We've seen oil go to 140, 150, and we've seen it go back down into the 30s, and now I don't even know where it's at. These can move very drastically based on a lot of things, not just the economy, right? Because yes, inflation's rising right now and interest rates are rising and commodities are feeling the effect of that in a positive way. But part of this is if we go into recession, that means there's less demand for goods, and those goods use commodities. So you can see how this can get very volatile. So if you do add them, Keith, then you have to stick to it. You have to stick to your process and having them in there, because otherwise you negate the idea of asset allocation and having it be a diversifier to everything else. Now you're just market timing to an extent. And that's not necessarily a bad thing if that's your process that you stick to consistently. So I haven't really refreshed my thinking on this a lot, but recently anyway, I did maybe 6, 7, 8 years ago. It can be a pure inflation hedge, but you always have to have the hedge before you need the hedge. And that's part of that long-term decision that you're making there. So hopefully, Keith, that gave you a more objective way of thinking through it so you can get to a decision for yourself. Our next question comes from Dennis, and this is on the perpetual withdrawal rate. Okay, we're getting our geek hats on a little bit here today. I've been listening to your podcast for a few years now and really appreciate the thoughtful approach. There is a great deal of information available about safe withdrawal rates, including the reasons that the 4% may be either too low or too high, as well as different spending strategies and how they impact withdrawal rates. There doesn't seem to be nearly as much discussion about perpetual withdrawal rate, which I think is just setting the withdrawal percentage at a low enough amount so that the original principal never decreases. As far as I can tell, the difference between a safe withdrawal rate and a perpetual withdrawal rate is only about 0.5 to 1%. Given the massive increase in safety with a perpetual withdrawal rate, I would think that this would be any planner's aspirational goal. I would love to hear your thoughts on this. Interesting question, Dennis. So let's define a perpetual withdrawal rate. Essentially, it's a withdrawal rate that over time would allow you not to ever touch your principal, the amount that you started with, as you take out money in an inflation-adjusted way. So it's going to be set a lot lower than the systematic withdrawal rate that's generally talked about. And in theory, what that means is that when you pass away, you will still have the principal that you started with in order to pass on to heirs or to charity or what have you. I'm trying to remember a quote, and I think it was from the book Anti-Fragile. There are so many things that we know that just really aren't worth knowing. And I think for me, this is one of them. I like the idea of withdrawal rates as a heuristic as a rule of thumb, but as a strategy to actually implement, I don't think that a perpetual withdrawal rate is an aspirational goal of a planner. Unless a client has very specific legacy goals that they want to leave the principal plus. Mathematically, I get that, hey, this is safe. I never have to worry. There's a lot of ways of making the withdrawal strategy structure safe so I never have to worry. And that is by working longer, saving more for the most of your life, and spending a lot less. Doing all of that will make everything a lot safer. But I'm going to retract part of what I said. It will never make you feel safer because you're never going to be exonerated from uncertainty. Even if you're massively overfunded and you're using a perpetual withdrawal rate, you're still going to worry. You're still going to fret. It's just the human condition. So that's one reason why I don't think this is worth thinking about too deeply. The second reason is the point of retirement is to create actual life outcomes. And life, let's say you're 60 years old here, Dennis, you are the youngest and healthiest that you'll likely ever be in this, say, 30-year periods before you pass. If you have children or you have a group of friends, they're more connected and together and younger and healthier than they will likely ever be. There's a lot of wanting to front load creating experiences today. Why? Because today is today. Tomorrow's not promised to anybody. So I liken retirement planning, and the objective is how do I use the resources I have to extract as much life as I can and still have confidence that I'm going to be okay later in life. Now, you can't really do that in a mathematical formula because the entire issue is so fluid. The markets are going to change, inflation's going to change, The economy is going to change. Your life is going to change in innumerable ways that you can't even imagine. And none of that fits into a mathematical formula. So process trumps formulas. Now, I think a withdrawal rate is a reasonable thing to look at from a high level, but from actually implementing it, I don't think this is an aspirational goal. Because if I were to aspire to implement this, Dennis, that means I'm going to force my clients to make decisions, or myself to make decisions, if it's for myself, that are going to detract from their life now, the life that they actually have, in order to implement this. Now, where that is not true, and where this could be a reasonable strategy, I think, Dennis, is if somebody is massively overfunded for their retirement. Because the way you choose how you're going to withdraw money from your retirement, one is psychologically what fits me to help give me confidence. The other is, where are you at from a fundedness standpoint? If you're massively overfunded, do a 4% withdrawal rate. Do a perpetual withdrawal rate, because that percentage, even if it's a 0.5% lower, is still going to give me so much if I just sell it when I need it to cover the kind of life that I want to have. And I have such margin because I have so much financial assets that if we get a bad market, no problem. I can handle it because I have all this excess capital to absorb that. So I don't like the framing of withdrawal rate. So that's where I've come to. I could call it a bias. Maybe I've thought through this and I don't think it's a reasonable way to actually do retirement. It's a cool way to talk about retirement. Lots of articles on this, but the people that actually are doing it and implementing retirement strategy don't use withdrawal rates. Good theory, but in practice, it doesn't fit life very well unless you're massively overfunded. So those are my thoughts. Hopefully that answered your question, Dennis. Our next question comes from David, and he has a question about a single pay annuity.
Hello, Roger. I really appreciate the show. I am a 64-year-old recently retired person, and I rolled a pension amount into a self-directed IRA with some other IRA funds. By all calculations and my expected spending, I should have enough to last 25 to 30 years. My primary question is there a resource or resources that I could use to determine if a single pay annuity might be a solution to my particular situation? I appreciate it. Thank you.
Well, thanks for the question, David. For everyone else who is facing a pension versus rollover decision, you want to be very careful to evaluate the pension and what kind of withdrawal strategy you want to use before you move it to an IRA. In my experience, and I don't know David's, the pension generally will have the best payout if you take it as a monthly payment for the rest of your life. So moving it to an IRA and then looking at it, immediate annuity in this case, generally you're not going to get the same payout that you would have gotten in the pension. Now, I don't know if this is the case for David, but that's one thing that you want to take a look at. So David, now that you have this money in an IRA and interest rates are rising up, so that'll influence these immediate annuities. Your question is about how, essentially a resilience question. Does it make sense to take this lump sum of money that's in this IRA and put it into an immediate annuity or even a deferred income annuity to give me a pension stream that will complement everything else you have going on? So this is in the resilience stage of your plan. And the way that you'll make that decision is going to be based off of, one, I feel more confident knowing I have, between Social Security and this immediate annuity income stream and whatever income streams you have, that covers my base great life. That makes me feel more confident, so I don't have to worry about the markets near as much. It's a lot easier to manage. Psychologically, if those fit and empower you to live a better life, then that's the first place you want to start. And if that's the case, which is cool, now it's how do I decide how I do this and where I do this and whether it actually makes sense. But I think if financially it may or may not, but if personally it makes sense, I would lean that direction a little bit. My suggestion would be and you can use software for this. There's New Retirement, which is free. There are a number of different new software programs out there, is to create a plan of record without having the annuity stream. So you have that lump sum in your IRA as financial assets, and then build a plan without that annuity stream that you build out your pie cake. You get at least 5 years of your spending pre-funded that you're going to take from your assets. You can consider going out 8 or 9 years in that income floor perspective to give you more safety if it's a psychological item here. And then you maintain control of the assets. And as your life changes, you have a lot more liquid pieces to move around. But I would create a plan of record with that in place, a 5 to 8 year income floor. Once you have that in place and say, okay, I get how this works. This makes sense. I see where my income's going to come from to pay for life, knowing that in the future it gets a little bit more murky, but that's a long time away anyway. Once you have that plan of record in place, using whatever software or spreadsheets that you're using there, David, or if you're using an advisor, have them created. They should know how. Then create a what if scenario. So you create a carbon copy of that plan that you just put to place, your plan of record, your resilient plan of record. And then you model, well, what if I took X amount from my IRA in this case and purchased an immediate annuity or a guaranteed income stream for the rest of my life? And your advisor and their online resources, I tend to use an insurance broker when I'm looking at this because I dropped my insurance licenses long ago. I have an insurance broker that works with a lot of different firms, and I tell them I don't want the fancy stuff. I want an immediate or deferred income annuity, and it's a mathematical formula. They can get quotes from multiple companies really easy and say, hey, I'm David. I give you $500,000. I want an immediate annuity. Show me 4 firms and what their payout is for my life only. Simple thing to do. You just need to find an insurance broker that works with multiple companies and let them come back and show you what they have. Because whether you go to the insurance company directly or use an insurance broker, it's going to cost you the same amount of money. Now, what they will likely come back with is multiple companies plus some other options that are going to be more financial engineering. Now, some of those can be attractive, but they can muddy the situation. So be careful as you go down those routes, but they likely will come back with those because they're higher commission products. And some of them are nice, actually. And then once they give you the payout, then you can take your carbon copy of your retirement plan of record and say, okay, I'm taking out $500,000 and I'm inserting this income stream. And then you can compare your plan of record to that. And you can see how much of your base great life is covered. You can perhaps be more aggressive with the remaining assets because, hey, your life is covered between all these payments. So that's one good way to approach this, David. Another way to approach this, depending on how old you are, and I know we did this in a flat fee plan recently with someone who was a little bit younger in their late 50s. We created a base plan of record, and then we did a what if scenario of, because David, you may say, I think I want to have this easier route of these guaranteed income streams, knowing there might be less upside, but I'm 60. I don't really want this to turn on until I'm 70. You could look at a deferred income annuity that starts at age 70, or you could look at a deferred income annuity, see how much it would cost to give you the income stream that you're desiring, but not actually pull the trigger and then segregate that money that would for that future annuity. So you have a bucket growing with the intent to buy that future annuity when you're 70 without actually pulling the trigger on it. And that way you maintain the flexibility. So that's how I would go about it from a structure standpoint, David. You ask for resources. I'm sure there are websites that will ask you these questions and send you a bunch of quotes. You're going to get on a marketing campaign because they're wanting to, that's what their business is. So be aware of that. I would go to an insurance broker so you can have a relationship with somebody. It's not going to cost you anymore, and they can go look at multiple companies. Our next question comes from Barry, and actually it's a suggestion. Barry says, hey, Roger, you should do a series about gray marriage, gray divorce, death of a spouse, and navigating the grown kids, prenup agreements, estate planning, new spouses, passing to her kids, your kids, etc. That's more than one theme there, Barry, but it's a great idea. We are going to do a series of going from 2 to 1, whether that's divorce or death, etc. And then as an ancillary to that, I guess we should go do a series on going from 1 to 2, that second marriage or that marriage where both parties are bringing assets in. So we do have going from 2 to 1 on the docket for a month-long series, but maybe we should have going from 1 to 2 as well. So thanks for the idea, Barry. Our next comment is actually a correction from Ryan, who is a financial planner who emailed me about my answer to the net unrealized appreciation question, the NUA. He corrected me, and I wanted to appreciate you, Ryan, for taking the time to correct me. If you do an NUA where you take the stock out and you pay the tax on the cost basis, you don't actually have to own it for 12 months to get the long-term gains tax treatment ultimately when you sell it. So thanks for the correction, Ryan. I appreciate that, man. Our last question is from Jim.
Hi, Roger. My name is Jim, and I'm 55 and hoping to retire in 5 years. I started listening to your show in mid-2020, and I've learned a lot since then. I've gone from being hopefully ignorant about my retirement to having a financial plan I'm comfortable with, and I'm even more excited about all the non-financial plans I have. Thank you. I have a question related to this crazy market and economy. Two main themes I keep hearing about investments is the power of compounding growth and the idea of buying when prices are low. My question is, do these two things cancel each other out? I'm still buying now when prices are low, and that should hopefully pay off when prices increase in the future. But my existing investments aren't compounding during this time, so I'm losing on that side of the equation. Do these two forces offset each other? Is there a way to estimate the net impact? I'm sure that my existing investments will eventually return to normal, but I'll lose a year or maybe more of compounding growth during that time. I'm not sure if any growth in my new investments will cover that. Thanks for all the time and effort you put into your show. You've had a large and positive impact on my current and future life. Please keep up the good work.
I'm excited to hear how empowered you feel from a confidence standpoint on your retirement, Jim. That's awesome to hear. Interesting question on this idea of buying low and compounding. I had a friend that started a business and he was working really hard. And any of you that have started a business, you know that you do a lot of work, take a lot of risk. Many times you run at a negative or barely break even, probably more of a negative early on, as you lay the foundation for hopefully growth, right? A positive cash flow perspective. And he is prospering now. But I remember when we had this conversation, we were talking about his struggles early on when he was doing this. And I sent him something in the mail that he still has hanging on his wall, and it's a hockey stick. Now, if you're familiar with a hockey stick, if you lay it flat with the blade going up, the hockey stick is very flat for a very long period of time. And then right at the end, when you get to the blade, it starts to go up and to the right. Cash flow is that way in a business. And the reason I sent it to him was when you're especially starting a business, it's going to be very flat and you may see some upward movement in growth in terms of revenue you will be, but the net bottom line of that growth, not so much. And then you hit this inflection point where you really start to see your free cash flow, your profit go up and up and up, assuming everything works out, right? That came to mind when you were asking this question, Jim, because that hockey stick-like growth happens with compounding. Now, it's not as clean as a hockey stick. There's lots of ups and downs, and we're feeling the downs right now. But the key to compounding is time frame and consistency. Long time frames are needed for compounding to really have its impact. That's the image of the hockey stick. Right now, when you've lost maybe 20, 30% of the value in those long-term assets because the prices have gone down, what you don't see, much like you don't see when you see a duck floating on the water, is you don't see the feet going underneath because your bond portfolio and your stock portfolio are issuing dividends and capital gains and interest. And generally with a long-term portfolio, those are buying more shares at today's prices. And as that happens consistently, and you don't really see it happening if you're reinvesting all of these things because it happens at the end of the year, you pay a little taxes on what was issued, but internally it's buying more shares. And over a very long period of time, that compounding still is happening, even though the prices are low. In fact, if XYZ portfolio pays $1 in dividend every year, that dollar is buying incrementally more shares now because of the bear market. So the key to compounding is time frame and consistency, very long term. even when things are bad, you're still doing that compounding, and it has this whipsaw effect on the tail end. So you actually are buying low. They're fairly compatible. That works for a very long-term perspective, and that's why time horizon is so important. Now, buying low, right now, you phrased it as you're buying low now, and that may make up for things as the markets recover. The difficulty with buying low is you might not be buying low. What if we go down another 20, 30%? Maybe what if we go down 50% from here? Buying here may not feel like you bought low. I was thinking I bought some technology investments in my health savings account at the beginning of the year. It's a very long term. I'm trying to be very growth-oriented, risky with those assets. Sure doesn't feel like I bought low now. Feels like I bought too early. So buying low when you have money, and I would say, rather than thinking about buying low, when you have money and you've worked through a process that, yes, I need to allocate this money for, let's say, 10 years plus, you just buy. Because you can't figure out what's low and what's high. But if you know it's at least 10-year money, statistically, that is in your favor. That put it towards your longer-term assets. If you try to game it and time it, and there may be some people that can do that consistently, the key there is, one, it's not just doing it once or twice or 3 times. You have to be able to do it consistently over a very long period of time, because what you introduce is not one decision, but multiple decisions that you have to make multiple times. So hopefully that gave you some perspective of how I think about it. Most of this stuff is very straightforward, but can become very complicated when we get in our head too much. And I always try to keep the main thing, which is have a great retirement outcome. So if you built out a plan of record that you have confidence in, which it sounds like, Jim, don't overthink it. I wouldn't worry too much about it, because your time is probably better spent on all the other pursuits that you said you were so excited about. So there's my perspective. With that, let's go set a smart sprint.
On your marks, get set.
And we're off to set a little baby step you can set in the next 7 days to not just rock retirement, but rock life. So in the next 7 days, grab the checklist that we're going to share in 6 Shot Saturday about things to consider before the end of the year. Look over that and find 1 or 2 things that might make an impact in your life and take action on it. We'll share a checklist in our 6 Shot Saturday email that we send out every Saturday with a summary of the show and our answers to these questions. If you're not signed up for that, you can go to rogerwhitney.com or 6shotsaturday.com to get that email. Thanks so much for joining me today. I am off on some year-end client meetings to go take care of. I hope you have a wonderful day, and we'll talk next week. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance reference is historical and does not guarantee future results. All indices are unmanaged and cannot be invested in directly. Make sure you consult your legal, tax, or financial advisor before making any decisions.